Study Session 1. Trial Balance. Introduction. A trial balance is a list of all the general ledger accounts contained in the ledger of a business. This list will contain the name of each nominal ledger account and the value of that nominal ledger balance. Each nominal ledger account will hold either a debit balance or a credit balance. The concept of trial balance. The process was first described by Luca Pacioli. The trial balance is usually prepared by a bookkeeper or accountant, who has used books to record financial transactions and then post them to the nominal ledgers and personal ledger accounts. The purpose of trial balance. The following are the purposes of trial balance. 1. To check the arithmetical accuracy of the ledger. 2. To help in locating accounting errors. 3. To provide the summary of transactions. 4. To serve as the basis for preparing final accounts. Features of trial balances. The following are the important features of trial balances. 1. A trial balance is prepared on a specified date. 2. It contains a list of all ledger account including cash account. 3. It may be prepared with the balances or totals of ledger accounts. 4. Total of the debit and credit amount columns of the trial balance must tally. 5. If the debit and credit amounts are equal, we assume that ledger accounts are arithmetically accurate. 6. Difference in the debit and credit columns points out that some mistakes have been committed. 7. Tallying of the trial balance is not a conclusive proof of accuracy of accounts. Limitations of trial balance. The following are the major limitations of trial balances. 1. The trial balance can be prepared only in those concerns where a double-entry system of bookkeeping is adopted. This system is too costly. 2. A trial balance is not conclusive proof of the arithmetical accuracy of the books of account. If the trial balance agrees, it does not mean that now there are absolutely no errors in books. 3. If the trial balance is wrong, the subsequent preparation of trading, P&L account, and balance sheet will not reflect the true picture of the concern. Steps in the preparation of trial balance. Trial balance is normally prepared at the end of an accounting year. However, an organization may prepare a trial balance at the end of any chosen period, which may be monthly, quarterly, half-yearly, or annually depending upon its requirements. In order to prepare a trial balance, following steps are taken. 1. Ascertain the balances of each account in the ledger. 2. List each account and place its balance in the debit or credit column, as the case may be. If an account has a zero balance, it may be included in the trial balance with zero in the column for its normal balance. 3. Compute the total of debit balances column. 4. Compute the total of the credit balances column. 5. Verify that the sum of the debit balances equals the sum of credit balances. If they do not tally, it indicates that there are some errors. Structure and component of a trial balance. The trial balance is divided into two sides, which are the debit and the credit sides. The debit side shows a list of assets, expenses, and drawings, while the credit side shows a list of capital, liabilities, income, and provisions. Significance of agreement of trial balance. It is important for the trial balance totally. Normally a tally trial balance means that both the debit and the credit entries have been made correctly for each transaction. However, as stated earlier, the agreement of trial balance is not absolute proof of the accuracy of accounting records. Errors affect the agreement of the trial balance. 1. Error in totaling the debit and credit balances in the trial balance. 2. Error in totaling of subsidiary books. 3. Error in posting of the total of subsidiary books. 4. Error in showing account balances in the wrong column of the trial balance, or in the wrong amount. 5. Omission in showing an account balance in the trial balance. 6. Error in the calculation of a ledger account balance. 7. Error while posting a journal entry. A journal entry may not have been posted properly to the ledger, that is, posting made either with the wrong amount or on the wrong side of the account or in the wrong account. Classification of errors. Trial balance means that both the debit and the credit entries have been made correctly for each transaction. 1. Errors of commission. 2. Errors of omission. 3. Errors of principal. 4. Compensating errors. Summary of Study Session 1. In this study session, please note the following. 1. Meaning of trial balance. A statement showing the abstract of the balance of various accounts in the ledger. 2. Structure and component of a trial balance. The trial balance is divided into two sides, which are the debit and the credit sides. The debit side shows a list of assets, expenses, and drawings while the credit side shows a list of capital, liabilities, income, and provisions. Study Session 2. Preparation of Financial Statements with Adjustments. Introduction. In these study sessions, you will be introduced to the meaning and purpose of the financial statement, components of the financial statement. The financial statement. The financial statement is a standard document that tells us how well a business is performing and where it stands in financial terms. It is a statement prepared by the management of an organization, which forms a yardstick for determining the extent to which a business has succeeded in achieving its ultimate aim, which is perhaps to make a profit. The components of the financial statement. The following are components of the financial statement. 1. Statement of financial performance. 2. The trading account. 3. Profit and loss and appropriation account. Statement of financial position. A statement of financial position is a summary of the value of all assets, liabilities, and ownership equity or capital for an organization or individual on a specific date, such as the end of its financial year. All other balances which are not closed into the profit and loss account are transferred to the balance sheet. The following is an example of the classification of assets. 1. Current assets. 2. Long-term investments. 3. Fixed assets. 4. Intangible assets. 5. Other assets. Liabilities. Liabilities are usually unpaid bills from suppliers. It is usually on the debit side of a balance sheet. Liabilities include 1. Equity. 2. Adjustable. Adjustments of items are as follows. 1. Accrual. 2. Prepayment. 3. Provision. In this study session, please note the following. 1. Financial statement. The financial statement is a standard document that tells us how well a business is performing and where it stands in financial terms. It is a statement prepared by the management of an organization that forms a yardstick for determining the extent to which a business has succeeded in achieving its ultimate aim, which is perhaps to make a profit. 2. The components of the financial statement. The components of the financial statement involve the financial position of the firm at a given period of time. The following are components of the financial statement. 1. Statement of financial performance. 2. The trading account. 3. The profit and loss and appropriation account. 4. Statement of financial position. Study Session 3. Detection and correction of accounting errors, the use of suspense account. Introduction. Errors are inevitable in a financial statement. In other words, it is normal for errors to occur. In this study session, you will learn about accounting errors, and the role and purpose of the suspense account in correcting accounting errors. Accounting errors. The entering of accounting information into the books of accounts, especially in large organizations where there could be a lot of accounting transactions, could be characterized by errors. An error is a mistake made in the bookkeeping entries, balancing of accounts, or extraction of the trial balance. It could also be defined as an omission in the bookkeeping process. Types of errors. Errors can be characterized into two major classes. 1. Errors that affect the trial balance. These are errors that cause the total of the debit balances to be unequal to the total of the credit balances extracted from the ledger. In posting entries to the ledger, we are expected to adhere strictly to the double entry principle, and therefore, it is only expected that the debit and credit totals of the trial balance should be equal. These errors that affect the trial balance can be classified into A. Technical errors. These are errors that are a result of the violation of the double entry principle and have to do with the omission of an aspect of the principle or the entry of an amount that is to be credited as a debit entry and vice versa. These errors have to do with posting to the debit and credit sides of the ledger and not with the amount involved. These errors are as follows. 1. Omission of one aspect of the double entry principle. In this case, a debit entry of a transaction is correctly entered in the books, but the corresponding credit entry is omitted and vice versa. For example, when sales for cash have been debited to the cash account but the credit to the sales account has been omitted. This would make the debit and credit totals to be different to the tune of the amount omitted. 2. Failure to post a subsidiary book. Subsidiary books are expected to be posted periodically after entries to the personal ledgers have been posted, but sometimes it could be possible that the subsidiary book was not posted at all. This would cause an error in the trial balance such that the totals would be unequal to the extent of the amount not posted to the ledger from the subsidiary book. 3. Double entry on the same side of the ledger. This occurs when both the debit and credit posting of a transaction is entered on the same side of the ledger, implying that both the debit and credit aspects of a transaction are credited to the account involved and vice versa. B. Arithmetic errors. Occurs when, although the debit and credit aspects of a transaction were entered in the books, the amount involved in one or both aspects was wrongly entered in the books such that the monetary value of the debt is not equal to the monetary value of the credit. Example: where payment to the creditor of 1,000 naira is debited to the creditor as 100 naira and credited to the cash book as 1,000 naira. Even though there is a credit and debit entry, the monetary value of the credit is not equal to the monetary value of the debit. Arithmetic errors are as follows. 1. Transposition of digits. This occurs when the digits of the amount involved in a transaction are interchanged in one aspect of the double entry. This error would lead to a difference in the trial balance which is equal to a number divisible by 9. 2. Undercasting and overcast of totals. This occurs when adding up amounts in the books. Where the amount added up is less than the actual amount, we have an undercast, and where the reverse is the case, we have overcast. Under and overcast occurs where a subsidiary book is being added up or during the balancing of an account. 3. Blunder. This occurs when the errors have no resemblance with the correct amount. Example: payment of electricity bill by check of 2,000 naira. The electricity bill account was debited correctly with 2,000 naira but the cash book was credited with 5,250 naira. There is no resemblance between these two figures. C. Extraction errors. This error has to do with errors associated with the preparation of a trial balance. It involves extraction to the wrong side of the trial balance, extraction of an incorrect amount, or the omission of a balance. This error affects the trial balance but not the ledger. These errors include: 1. Extraction of the wrong amount. Here, the amount extracted to the trial balance is correct in the ledger but wrong in the trial balance. 2. Extraction to the wrong side of the trial balance. Occurs when a balance that is on the debit side of the ledger account is extracted to the credit side of the trial balance and vice versa. This error would result in a difference in the trial balance which is twice the amount of the error. 3. Failure to extract a balance from the ledger. This is a complete omission of a balance in the trial balance. The suspense account. The suspense account is the temporary account into which the difference between the credit and debit totals is entered before investigation and correction of the errors. Once there is a difference in the trial balance due to errors that affect their trial balance, the suspense account is raised on the lesser of the two sides of the trial balance. Correction of errors that affect the trial balance. In correcting errors that affect the trial balance, we are required to have mastery of the double entry principle. The correction of errors takes three forms. 1. Correction of error by inclusion where there is an omission. 2. Correction of errors by cancellation and re-entry where the amount is entered on the wrong side of the ledger. 3. Correction of errors by deduction where we have an overcast and addition when we have an undercast. Errors that do not affect the trial balance. These errors include: 1. Error of principle. 2. Error of omission. 3. Error of original entry. 4. Error of commission. 5. Compensating error. 6. Error of complete reversal of entry. Summary of Study Session 3. In this study session, please note the following. 1. Definition of accounting errors. The entering of accounting information into the books of accounts, especially in large organizations where there could be a lot of accounting transactions, could be characterized by errors. 2. The suspense account. The suspense account is the temporary account into which the difference between the credit and debit totals is entered before investigation and correction of the errors. Once there is a difference in the trial balance due to errors that affect their trial balance, the suspense account is raised on the lesser of the two sides of the trial balance. Study Session 4. Introduction to Accounting Standards. Introduction. In order for balance sheets and profit and loss accounts to make sense to users who rely on them for their decision-making purposes, there has to be consistency in the way items are treated in the financial statements. History of Accounting Standards. The committee was raised by the American Institute of Accountants to issue standards. Committee on Accounting Procedure was formed in 1938 and operated till 1959, during which period it issued accounting research bulletins. In 1953, the Accounting Principles Board was formed, to take over the functions of the Committee on Accounting Procedure. In June 1973, the Accounting Principles Board was replaced by the International Accounting Standards Committee. The International Accounting Standards Committee was born out of the need to harmonize global accounting standards and practices to eliminate differences not attributable to environmental influences. Definition of accounting standard. An accounting standard is a principle that guides and standardizes accounting practices. The generally accepted accounting principles is a group of accounting standards widely accepted as appropriate to the field of accounting necessary so financial statements are meaningful across a wide variety of businesses and industries. Overview of International Financial Reporting Standard. International Financial Reporting Standards are a single set of globally accepted high-quality accounting standards issued by the International Accounting Standard Board based in London, UK. The International Accounting Standard Board has amended some international accounting standard and has proposed to amend others, has replaced some international accounting standard with new International Financial Reporting Standard and has adopted or proposed new International Financial Reporting Standard on topics for which there was no previous International Accounting Standard Board. The International Financial Reporting Standards since issued by the IASB are listed below. 1. International Financial Reporting Standard 1. First-time adoption of International Financial Reporting Standards. 2. International Financial Reporting Standard 2, Share-based payment. 3. International Financial Reporting Standard 3, Business combinations. 4. International Financial Reporting Standard 4, Insurance contracts. 5. International Financial Reporting Standard 5, Non-current assets held for sale and discontinued operations. 6. International Financial Reporting Standard 6, Explorations for and Evaluation of Mineral Rights. 7. International Financial Reporting Standard 7, Financial Instruments, Disclosures. 8. International Financial Reporting Standard 8, Operating Segments. 9. International Financial Reporting Standard 9, Financial Instruments. 10. International Financial Reporting Standard 10, Consolidated Financial Statements. 11. International Financial Reporting Standard 11, Joint Arrangements. 12. International Financial Reporting Standard 12, Disclosure of Interests in Other Entities. 13. International Financial Reporting Standard 13, Fair Value Measurement. 14. International Financial Reporting Standard 14, Regulatory Deferral Accounts. 15. International Financial Reporting Standard 15, Revenue from Contracts with Customers. Problems faced with IFRS implementation. 1. The problem of Anglo-Saxon dominance. Both South America and North America have 7 members of trustee with only 1 from Africa. 2. There is a need for compliance with International Financial Reporting Standard by the adopters. The International Accounting Standard Board has not been able to monitor the extent of compliance by the countries that has adopted International Financial Reporting Standard. International Accounting Standard 8, Accounting Policies, Changes in Accounting Estimates and Errors. 1. Accounting Policies. 2. Changes in Accounting Estimates. 3. Accounting Errors. International Accounting Standard 16, Property, Plant, and Equipment. Property, plant, and equipment are tangible long-term, revenue-yielding assets useful in the production or supply of goods and services or held for the daily operational activities of the business. 1. Recognition of the asset. 2. Property, plant, and equipment measurement after recognition. 3. Revaluation method. 4. Depreciation. 5. Impairment of asset. Summary of Study Session 4. In this study session, please note the following. 1. Meaning and history of accounting standards. Accounting standards have been described as rules comprising of best practices issued by a duly authorized body. The standard-setting bodies or institutions function by reviewing existing accounting practices and principles and recommending through a standard. 2. Overview of International Financial Reporting Standard. International Financial Reporting Standards are a single set of globally accepted high-quality accounting standards, issued by the International Accounting Standard Board based in London, UK. 3. International Accounting Standard 8, Accounting Policies, Changes in Accounting Estimates and Errors. This standard prescribes the criteria for the consistent selection of accounting policies, addresses changes in the accounting estimates and provides the basis for correcting accounting errors. The standard is intended to enhance the relevance and reliability of financial statements. Study Session 6. Recording of Incomplete Records. Introduction. In this study session, you will be learning about the concept of the incomplete record, pure single entry, quasi-single entry. The concept of incomplete records. Incomplete records can be defined as a bookkeeping system where double-entry systems are not maintained. In this chapter, attention is drawn to the fact that in most cases, especially in enterprises that are managed by a single owner, the double-entry system that we have used in the previous chapters may not be in use. Sometimes only a list of transactions is available or the recording system is not complete. Components of incomplete records. A single-entry bookkeeping system does not really describe any type of bookkeeping. However, the single entry can be described as a process where business transactions are not recorded twice. Generally, there are two types of single-entry bookkeeping systems. These are called 1. Pure single entry. 2. Profit as an increase in capital. Using other methods to draw up the financial statement. The use of the capital method of arriving at the net profit figure is obviously not very satisfactory for the fact that other financial statements such as trading, profit, and loss accounts are neglected. The capital method should be used sparingly. The information communicated through the trading, profit, and loss statement is so important that all businesses, whether keeping their books in a single entry, incomplete records, or a double entry system ought to prepare them. Quasi-single entry. In such a situation, the following logical steps must be followed to achieve a meaningful result. 1. Careful analysis of cash receipts and cash payments using the bank statement and preparing a summary of lodgement and withdrawal from the bank. A vivid account of cash received was not lodged into the bank. 2. Distinguishing as far as the possible amount used for business purposes and those used for private purposes. 3. Estimate as accurate as possible amounts of stock, debtors, and other assets as well as accrual, creditors, and other liabilities outstanding at the beginning and end of the accounting period. 4. The difference between the assets and liabilities at the beginning of the accounting prepared under a statement of affairs will be the amount of opening capital. Summary of Study Session 6. In this study session, please take note of the following. 1. The concept of incomplete records. Incomplete records can be defined as a bookkeeping system where double-entry systems are not maintained. 2. Pure single entry. This pure single entry system does not involve debit and credit. 3. Quasi-single entry. Oftentimes, a small business unit usually keeps records of its cash receipts and payments and at best personal accounts of debtors and creditors. Study Session 6. Recording of incomplete records. Introduction. In this study session, you will be learning about the concept of the incomplete record, pure single entry, quasi-single entry. The concept of incomplete records. Incomplete records can be defined as a bookkeeping system where double-entry systems are not maintained. In this chapter, attention is drawn to the fact that in most cases, especially in enterprises that are managed by a single owner, the double-entry system that we have used in the previous chapters may not be in use. Sometimes only a list of transactions is available or the recording system is not complete. Components of incomplete records. A single-entry bookkeeping system does not really describe any type of bookkeeping. However, the single entry can be described as a process where business transactions are not recorded twice. Generally, there are two types of single-entry bookkeeping systems. These are called 1. Pure single entry. 2. Profit as an increase in capital. Using other methods to draw up the financial statement. The use of the capital method of arriving at the net profit figure is obviously not very satisfactory for the fact that other financial statements such as trading, profit and loss accounts are neglected. The capital method should be used sparingly. The information communicated through the trading, profit, and loss statement is so important that all businesses, whether keeping their books in a single entry, incomplete records, or a double entry system ought to prepare them. Quasi-single entry. In such a situation, the following logical steps must be followed to achieve a meaningful result. 1. Careful analysis of cash receipts and cash payments using the bank statement and preparing a summary of lodgement and withdrawal from the bank. A vivid account of cash received was not lodged into the bank. 2. Distinguishing as far as the possible amounts used for business purposes and those used for private purposes. 3. Estimate as accurate as possible amounts of stock, debtors, and other assets as well as accrual, creditors, and other liabilities outstanding at the beginning and end of the accounting period. 4. The difference between the assets and liabilities at the beginning of the accounting prepared under a statement of affairs will be the amount of opening capital. Summary of Study Session 6. In this study session, please note the following. 1. The concept of incomplete records. Incomplete records can be defined as a bookkeeping system where double-entry systems are not maintained. 2. Pure single entry. This pure single-entry system does not involve debit and credit. 3. Quasi-single entry. Oftentimes, a small business unit usually keeps records of its cash receipts and payments and at best personal accounts of debtors and creditors. Study Session 7. Accounts of Non-Profit-Making Organizations. Introduction. Their financial record is called the account of non-profit-making organization. Therefore, in these study sessions, you will learn the concept of non-profit-making organization, receipt and payment account, and income and expenditure account. Concept of non-profit organizations. This topic is intended to expose students to the nature and types of organizations, clubs, and societies, or any other organizations, which are non-profit making. The students are able to appreciate and understand the effect of the various schemes like the Life Membership Scheme, and donations. This includes the treatment of life membership, donations, grants, and subscriptions among others, in the financial statements. Acceptable clauses indicating non-profit character. The non-profit status is conferred on an organization seeking to be non-profit making organizations. Such status are couched in the clauses in organization constituent documents. They include 1. Non-profit status clause. The clause states that the assets and incomes shall be solely applied to further the objectives for which the organization was set up. 2. Dissolution clauses. In the event of dissolution, the remainder of assets shall be applied for the satisfaction of all debts and liabilities. Books of accounts for a non-profit making organization. 1. Receipt and payment account. This is a summarized cash book which is prepared from the records of cash transactions made on a day-to-day basis. All cash receipts and payments are recorded in the receipts and payments accounts whether these belong to the current year, a future year, or even previous year, and whether the cash receipts and payments are capital in nature or not. Notably, the receipt and payment is debited with the opening balance of cash in hand or at the bank, and sums of all cash actually receipts are credited with all cash payments during the period whether or not all such cash payment has been accrued during the period. Cash received or payments made that relate to cash or payments actually made are prepared on a cash basis. The following comprises the sources of cash receipt or income by the non-profit organizations. 1. Subscriptions collected from members. 2. Sales of refreshments to members or non-members. 3. Raffles. 4. Publication sold. 5. Dinner tick sales. 6. Income or interest on a deposit account. 7. Donation, entrance fee, life membership fees. Conversely, the following constitutes payments, expenses to non-profit making organizations. 1. Purchase. 2. Cost of running an annual dinner. 3. Acquisition of fixed assets. 4. Rent of hall. 2. Income and expenditure accounts. This account remedies the limitation found in the receipt and payment account in that it is based on an accrual basis, reflects the ability of the organization to meet the obligation of expenses including depreciation out of incomes. The income and expenditure accounts is prepared by non-profit making organizations to enable them to ascertain their income and expenditures. Usually, when income is more than the expenditure during the year, the organization is said to have surplus or excess over income over expenditure. However, where expenditures are over the income, the organization has a case of excess of expenditure over income. Income and expenditure is debited with all expenditure and credited with all income of a period, whether or not it has been paid or received within the period. The preparation of income and expenditure is simple, usually from the RNPA. It is expected that all revenues appearing in the RNPA, as debits, are usually credited to income and expenditure, with adjustment for accruals and prepayments at the beginning and end of the period. In a similar way, all payments made in the RNPA, as credits, are debited to INDA adjusted for accruals. But capital items appearing in RNPs as debits or credits will be appearing in the relevant assets and liability accounts, and this will not affect the INDA. Statement of financial position. The statement of financial position of a non-trading or non-profit organization is prepared the same way as that of the trading organization or profit-making organization. The balance sheet of a non-profit organization contains particulars of assets and liabilities. However, the excess of assets over liabilities in a non-profit organization is termed the accumulated fund or general fund. Treatment of entrance and subscription fees. 1. Entrance fees are paid once from members who are joining the organization. There are arguments that entrance fees should be treated as capital receipts since payments are made once, but the other argument is that members may be enrolled every year. It should be credited to the income and expenditure. It must however be noted that in the absence of any specified treatment, it should be treated in either way, either as an income or capital receipt. There should be consistency once a method is chosen. 2. Subscription. Subscription fees are collected annually from members as per rule. Such fees are collected or paid to serve the purpose for which they were credited. As expected, like every other source of revenue, subscriptions are debited to the R&PA and credited to income and expenditure with caution, taking credit for only those subscriptions which are relevant. Subscriptions in arrears may never be received, and so, treating them as debtors at the balance sheet could distort the balance sheet. However, whatever treatment is desired, it must be consistent. If subscription in arrears appears in the balance sheet, the beginning and ending subscription in arrears must reflect in the balance sheet. Summary of Study Session 7. In this study session, please note the following. 1. The nature and types of organizations, clubs, and societies, or any other organizations, which are non-profit making. The students are able to appreciate and understand the effect of the various schemes like the Life Membership Scheme, and donations. This includes the treatment of life membership, donations, grants, and subscriptions among others, in the financial statements. 2. The cash receipts and payments are recorded in the receipts and payments accounts whether these belong to the current year or future year or even previous year, and whether the cash receipts and payments are capital in nature or not. 3. The limitation found in the receipt and payment account in that it is based on an accrual basis, reflects the ability of the organization to meet the obligation of expenses including depreciation out of incomes. Study Session 8. Inventories, Stock Valuation, International Accounting Standard 2. Introduction. Have you ever visited a supermarket where various provisions, food items, home-used items, etc. are sold? If you carefully observe, you will notice that every item on the shelf has a price tag, indicating the price of each item, which enables the customer to know the worth of the items and make their choices. Definition of inventory. Stock can be defined as any item or asset, whether raw material, work in progress or finished goods in store for resale or input for further production. It should be noted that an asset for a particular company may be stock for another company. For example, a motor vehicle for a bakery, which is an asset, is considered stock for a car dealership company. Subheading. Concepts of valuation. There are a number of valuation terms as it relates to inventory or stock valuation, which include the following. 1. Expected selling price. Price at which stock can be sold in the market currently. 2. Net realizable value. This is the selling price less cost associated with selling the stock currently in the market. 3. Replacement cost. Cost of replacing the stock at current market value. 4. Historical cost. International Accounting Standard 2 states that the cost of inventory shall comprise all costs of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. 5. International Accounting Standard 2. This sets out the requirements to be followed when accounting for inventory. Measurement of inventory is very important for financial reporting and preparation of financial statements because the valuation affects both the statement of profit or loss and the statement of financial position with respect to profit, cost of sale, and assets. 6. The measurement rule. International Accounting Standard 2 requires that inventory be measured at the lower of cost or NE. Realizable value. It should be noted that net realizable value is usually higher than cost. However, when inventory loses value, perhaps because it has been damaged or obsolete, net realizable value will be lower than cost. 7. Stock taking. It is the determination of the physical quantity of stock by physical count. 8. Periodic stock taking. This involves the counting of stock once a year, usually at the end of the year. 9. Continuous stock taking. This is used when stock is large. Counting is arranged such that different items are counted on different days or times of the year. There are 3 bases of comparing cost with net realizable value. 1. Global basis. 2. Item-by-item basis. 3. Batch basis. Stock valuation methods. There are 4 methods of stock valuation. 1. First in first out. 2. Last in first out. 3. Weighted average price. 4. Simple average price. International Account Standard 2 recognizes just 2 methods, which are first in first out and weighted average price. First in first out. Under this method, there is an assumption that stocks received first are issued first. This implies that issues are priced at the price of the oldest batch in stock until all units of that batch have been issued, then the price of the next batch is used, and so on. Weighted average price. Proceeds are valued or priced at a weighted average which is obtained by dividing the value of the stock by the unit of stock. Issues will be priced at this new price until a new batch is received and a new weighted price is calculated. Note: first in first out understates costs of goods sold, overstates closing stock value and gross profit. Summary of Study Session 8. In this study session, please note the following. 1. Inventory. Stock can be defined as any item or asset, whether raw material, work in progress or finished goods in store for resale or input for further production. It should be noted that an asset for a particular company may be stock for another company, for example, a motor vehicle for a bakery which is considered stock for a car dealership company. 2. Stock valuation methods. There are 4 methods of stock valuation. 1. First in first out. 2. Last in first out. 3. Weighted average price. 4. Simple average price. Study Session 9. Bill of Exchange. Introduction. A negotiable instrument is a document guaranteeing the payment of a specific amount of money, either on demand or at a set time, with the payer named on the document. More specifically, it is a document contemplated by or consisting of a contract, which promises the payment of money without condition, which may be paid either on demand or at a future date. The term can have different meanings, depending on what law is being applied and what country it is used in, and what context it is used in. This study session is designed to introduce you to all about bill exchange, the various types of bills exchange, and the treatment of bills exchange. Concept of bill of exchange. A bill of exchange is an unconditional order in writing, addressed by one person to another, signed by the person, requiring the person to whom it is addressed, to pay on demand or at a fixed or determinable future time, a sum certain in money to order the order to a specified person or to the bearer. The Geneva Convention lists some basic features that must be present in an instrument to qualify for a bill of exchange, and these features include: 1. The words, "Bill of Exchange," must be inserted in the instrument. 2. It is an unconditional type to pay a determinable sum of money. 3. Should have the name of the person who is to pay. 4. A statement of the time of payment. 5. Place where payment is to be made. 6. The name of the person, whom, or whose order is to be made. 7. A statement of the date and the place where the bill is issued. 8. The signature of the person who issues the bill. Parties to a bill of exchange. The drawer. This is the party that writes or issues a bill of transaction. He is usually the seller or creditor. The drawee. This is the party to whom the bill of exchange is addressed. This is the debtor or the buyer. He is the recipient of the bill of exchange meant for payment or acceptance. The payee. This is a party to the bill of an exchange transaction. He could be one of the following. 1. Some other person named on the bill. 2. Any other person to whom the bill has been negotiated. Any other person may be the banker. Advantages of the bill of exchange in trade. The bill of exchange has some functions it performs include: 1. Facilitation of trade credit in a legal format, permitting payment at a future date. 2. It provides formal legal evidence of the demand for payment from a seller. 3. It provides the seller with access to finance allowing endorsement or negotiation with financial institutions or banks, hence it creates liquidity. 4. It gives a stronger legal claim to the financial institution or banker against the buyer and seller. 5. It permits greater security for the seller over the payment by guaranteeing a drawee's acceptance. See the bill of exchange. 6. Bill of exchange protects the seller's access to the legal system, and easier access to the legal system in the event of any eventualities. 7. An accommodation bill is a means of finance for the drawer. 8. A bill is evidence of payment. 9. By drawing up a bill, the risk and expenses associated with remitting large sums are avoided. Types of bill of exchange. Bills of exchange fall into the categories of: 1. Inland bill. This is a bill which is or on the face of it purports to be drawn and payable in Nigeria or drawn within Nigeria upon some person resident in Nigeria. 2. Foreign bills. This is a bill drawn in one country and paid in another country. In all practical sense, a foreign bill is one that does not fall into the definition of an inland bill. Bill of Exchange Act in Nigeria, 1990. 3. Accommodation bills. These are bills drawn for the purpose of obtaining temporary monetary accommodation for either the drawer or the acceptor, and although the bill has the inscription, "For value received," accommodation bills do not represent genuine trading transactions. 4. House bills. These are in effect accommodation bills drawn by the head office of a trading company upon one of its branches or agencies, or bills written or drawn by the branch or agency upon the head office. Such bills are discounted to provide the drawer with funds for long transactions. 5. Dishonored bill. A bill is dishonored when on maturity the acceptor fails to fulfill his part of the contractual agreement, to pay the face value of the bill. When this occurs, his indebtedness is restored. The entries will be to reverse the entry in the bill's receivable account, by crediting that account while the account of the person from whom the bill is received is debited. 6. Retired bill. A bill is said to be retired when either rebate or for renewal. Rebated bills are or may be met before the due date. Acceptor A requests the drawer to allow the bill in question to be withdrawn and a new one of higher maturity date be substituted. This new arrangement will necessitate some interest in favor of drawer. 7. Short bills. These are bills which are paid into the bank for collection on maturity. They have not discounted bills, neither are they entered in special accounts when they are paid into the bank. The bank merely acts as collecting agents, not as debtors to these bills. 8. Rebated bills. These are bills which are discharged before the due date. When this does occur, the discharged bill's proceeds become less than the face value of the bill because of some rebate occasioned by earlier than maturity discharge of the bills. On retiring a bill under rebate, the following entries are called for. 1. The cash book is credited. 2. The bill payable account debit, with the net amount paid and discharge of the bill, while the amount of the rebate goes to interest account or to discounting charges accounts, and debited to bills payable account. 9. Bills receivable. In the books of the drawer of a bill receivable is an asset. The asset status is achieved when the bill drawn on the drawee is accepted by him. In the final accounts, the debtor is simply replaced with the bill receivable. 10. Bills payable. This is the mirror image of the bill receivable in the books of the acceptor. It is a liability in the books of the acceptor. The liability status is achieved when the drawee accepts the bill drawn on him by the drawer. Bills can also be categorized based on the time frame. 11. A sight bill. This is a bill payable at sight or on demand. 12. A tenor or issuance or term. This is a bill payable after a specified number of days of presentation. For instance, payable 90 days after sight of date. Note: noting fee or charge is an expense against the debtor, and it is incurred when the holder of the bill or debtor protests or notes the inability of the debtor to honor the bill on maturity. Summary of Study Session 9. In this study session, please note the following. 1. A bill of exchange is an unconditional order in writing, addressed by one person to another, signed by the person, requiring the person to whom it is addressed, to pay on demand or at a fixed or determinable future time, a sum certain in money to order the order to a specified person or to the bearer. 2. Different types of bills of exchange were also explained to you in this session.